And 3, 2, 1. Welcome back to the show.
And we're back again for another week.
We are.
It is the end of January. That is fantastic. It's starting to warm up. Well, it's going to snow a little bit. Probably, I guess February is kind of the worst snow month around here. But
It is weird.
we shall see. We shall see.
I just got back from Michigan, which had 5 inches of snow in like one day, and
Ugh.
we haven't had any. It was weird contrast coming back here, and it's like almost 50 degrees. And I'm like, are we in Key West? This is cool.
Yeah,
All right,
one
man.
can only wish.
I know, right? What do you got for us this week?
So it was another good week for the market. Kind of crazy that the pundits are all saying that the first half of the year stocks are supposed to crash. Second half of the year we're supposed to have a recovery. That's not the way that it played out for the first month. And something we're going to get to next week, I think, is the end of this January trifecta, right? We had the Santa Claus rally, the first 5 trading days of the month, and then the closing for the month of January. So if all 3 of those are positive, then the year, that year is, I mean, it's almost 100% significantly up.
Wow. Let's hope.
So, I mean, stats are stats and all that.
It's an inside joke when I say let's hope.
Yeah. But so,
hope is not a plan.
Hope is not a strategy, but it's kind of amazing in the face of all the I don't even want to say fear-mongering, because they are legitimate things that can go wrong and probably will go wrong throughout the year. All the yield curve has been inverted for months. Sooner or later, we're going to get some repercussions from that. It hasn't happened sooner. Maybe it's going to happen. I don't know how it's going to turn out, but right now the charts are pointing up, so that's the only thing we're focusing on. But before we get to the charts today, something a lot of people have been asking about is, okay, if I'm not a government employee, or if my spouse is working, she's not a government employee, she, but they have a 401k, right? Can we kind of follow this GrowMyTSP methodology and in their 401k?
And we
right?
say yes.
Say yes.
We do the same thing in our 401k.
Right.
Because we have a 401k in the company that we have that runs this whole thing, and we are employees of that company, and we have a 401k, and it allows and we have just the same limited options that everybody else does.
Right.
Nothing fancy, and we're able to use the same methodology.
Yep. And then the other thing is an IRA, right? If your company doesn't offer a 401k, or if you just have an IRA on the side, I'm going to kind of talk about that and the differences between an IRA and a 401k. And then Vanguard is one of the most popular companies that offer 401ks or IRAs. So
providers of a 401k, they have to contract with someone, and so the provider. What we've seen, and since I've left the government in 2015, I've had a few gigs where they had 401ks, and I've only ever, and one of those was actually a state government. I was working for DC, and they had Vanguard, every place I've been. So if there's some other options, can you guys throw it in the comment section and we'll go look at them?
Right.
But we don't know. I haven't seen any other ones, so I'm not even sure if there are other ones.
There are other ones, but Vanguard, I think, is the most
predominant.
Yeah.
Probably, yeah.
So that's why we're kind of going to use Vanguard when we get to it. And then we'll take a look at the TSP fund charts. Okay, so 401k IRA. Your spouse has a 401k. You're still in the military or the government, but you have an IRA outside of the TSP, right? It could be Vanguard, Fidelity, American Funds, T. Rowe Price. There's a handful of others that it could be. We're going to focus on Vanguard here when we get to it. And then there's some differences in 401k and IRA versus mutual funds and ETFs. And we're going to take a look at that also.
Are you going to talk about fractional shares at all?
No.
Okay. Can I throw that out?
You can throw that out.
It's one of my biggest frustrations. So if you go looking for, first of all, I don't know that you're ever going to find any place in a 401k that, even if you have a brokerage window, will allow you fractional shares. So I'll say that all at once. So what I'm really talking about is IRAs. And we went through this, several IRAs. Really comes down to only 3 that I know that have something that's workable as fractional shares. And what that means is, so let's say Apple's selling for $150. If you don't, you would have to spend $150
to buy a share of Apple.
Buy a share. Fractional means that you can do kind of what we do in the TSP, which is you can kind of do it percentage based.
Yep.
So you can take your whole portfolio and say, I want 20% Apple and 10% Tesla. And that's probably not great examples because we tend to work with indexes, but I'm trying to give you guys an example with one stock. The point is you can buy fractions of that share. Yep. It makes it very flexible. The only three places that I know of right off the top of my head are Fidelity is number one. We have a lot of frustrations with Fidelity just because of their tool set, right? Yep. Has nothing to do with Fidelity. I love their fees and their commissions and all that stuff, but their tools are kind of antiquated, right? Schwab has a thing called the slices, so it's not true fractionals. Fidelity's got a lot more options, and the other one is
Interactive Brokers.
Interactive Brokers. Yes, thank you. I can see the acronym, and I was like, what was it again? Interactive Brokers. A lot of people don't know about that company, but if you're a big tech geek nerd like me, what you'll find is that if you use something like we use TradingView, it's a very good charting platform and technical analysis platform. You can actually attach that to your Interactive Brokers IRA account, and you can do all kinds of fun things. So at the end of the day, those are the only three that I know of off the top of my head. I might have missed one. TD Ameritrade we know doesn't, and some of the other ones don't. So if you are okay with buying big chunks, if you got $1 million in your IRA, it's not as big a deal.
Right.
But if you've got 100,000, it starts to get a little wonky when you're trying to buy full.
Yeah. It's just not as simple as assigning percentages.
Right. That's the part you always got leftovers.
Right.
So where do you draw the line? It gets to be mind numbing. So we actually defaulted to a place that we can do fractionals, right? Yep. We're Fidelity, and I have one at Interactive Brokers also. But anyway.
Yep. Yep. We're going to kind of get into some of that other stuff too. Okay. So 401k, your company may or may not offer it, right? Your company will seek out, if they want to offer you a 401k as an employee, they're going to seek out a provider. It might be Fidelity, Schwab. We use Ubiquity. There are some other companies out there that are 401k providers. Okay, just like a healthcare provider or anything else. It's not something that your company creates. They are outsourcing your 401k. Your company is the sponsor, okay? And so the company decides matching, whether or not they're going to have a mutual fund window, a brokerage account option, those kinds of things. The 401k company, okay, the contracted company, is overseen by another company that's called FINRA, and we're going to get into that a little bit. The 401k company uses funds, right? So Fidelity has their own funds, Vanguard has their own funds, T. Rowe Price, and if you use the funds, so if your company contracts with Fidelity and you use Fidelity's funds, the rates, the fees are much cheaper. You could use SPY, for example, is a BlackRock product, right? The spiders. It's a BlackRock product. You can buy it through Fidelity, but you're going to get a better rate if you buy the VOO, which is the Fidelity. That's an ETF. If you buy Fidelity's version of it, of the S&P 500, you're going to get it cheaper than you would be if you bought BlackRock's version on the Fidelity, being contracted with Fidelity. And 401k, so same as TSP, IRS regulates the contributions that you can do, and in 2023, the max that you can contribute is $22,500 plus another $7,500 if you are over age 50. So the point of this slide basically is your company may or may not offer 401k, and if they do, they're contracting out to a company to provide the 401k for you. Your company makes the rules. They can change the rules. Your company is the one that makes the rules. Just like TSP, we had the refresh there in the middle of last year, and they added the mutual fund window, right? Same kind of idea. Okay. So FINRA is called the Financial Industry Regulatory Authority. Sounds like a government agency. It is not a government agency. It's a private American corporation, acts as a self-regulatory organization that regulates member brokerage firms and exchange markets. So a couple things I just wanted to point out here. They're basically contracted by the SEC. Okay, so they say they work under the supervision of, they're not a government agency themselves. They're a contracted company to do these services. They write a bunch of the rules, and they do compliance oversight for the 401k companies themselves. Okay. And you can go to the link right there. It's the FINRA link. It's pretty interesting. They do a lot of different stuff. Okay. So in terms of 401k, right, these were kind of the highlights that I wanted to point out. The variety of investments available in your 401k will depend on your plan provider, right, which we said is your company. Your company, plan provider is the company that your company contracts with. So let's say Fidelity. So the variety of investments available in your 401k will depend on your plan provider and the choices your plan sponsor makes. So if your provider is Fidelity, let's say, or in our case, we use Ubiquity. So let's do that because it's simple for me to explain. So if your plan provider is Ubiquity, your company that you work for hires Ubiquity to provide you a 401k plan. The provider has a menu of things that the company can allow you to use in your 401k. Your company is the sponsor. Your company gets to make the choices that you're going to have access to in your 401k. Okay? Generally speaking, no, what's on the next slide? So yeah, generally speaking, your employer is the 401k sponsor. This is what I was trying to get to. The most common type of investment choice offered by a 401k plan is the mutual fund. So this is something that it just boggles my mind that it is the case. It really drives me crazy because mutual funds generally are more expensive than ETFs, and ETFs have been around. I want to say they just did. It was either the 20 or 30 year anniversary of the first ETFs that came out. So ETF is a way better way to organize an ability to buy multiple stocks in one trade. You pay way less fees than mutual funds, but for whatever reason, the majority of 401k plans are still stuck in mutual funds.
But we know why. Because the system,
yeah,
you know this one.
It's the way we've always done it. Yeah.
The system is built for not actively managing your retirement account.
Well, right, true.
That is how this entire system is built. And until we broke that cycle in our brain years ago, and a lot of people are breaking that cycle now, not just us, but the cycle being that I'm only going to give you access to these very safe kind of long-term things, even though they're not going to perform well for you. Right. Like you're probably not going to make a lot of money off of it, but you're okay because you don't really know what you're doing anyway. Right. So we're not going to give you a bunch of options. Right. Brokerage windows, mutual fund windows, in the 401k speak would be brokerage window, because who wants access to mutual funds? You already got them. Right. But brokerage window, like we have that in our 401k, that took a long time for that to be an option. The system is built to not actively manage your 401k. Why? Because the system, which is financial advisors and big financial planners, financial advisors, they make their money off of managing your money, right? And you can't manage someone's 401k unless you let them log in for you, or they tell you when to make it move or whatever. But they can't make any money off that. They're not managing that money, so they don't make any assets under management, right? And so there's no incentive for the providers to give us better choices. Right.
Just more work for them.
Exactly. Because it's just like the TSP. Why would they give more options when we're fine the way we are? Right. And so, we came across this when we got our 401k that we're like, what do you mean our only choices are mutual funds? Yeah. We have a brokerage window, but we don't have fractionals, and that's the whole thing we were just talking about a minute ago. So it actually became better in a long term for us to use our methodology within it. And I know that's where you're going. But I think it's important for people to understand the underlying reason. Well, why is there mutual funds? Well, it's just because as this, 401ks actually haven't been around that long. Like
70s.
We're older than most of us are older than 401ks. So when you take that into consideration, now I wish there was a way you could, if there's a provider out there you guys know of that provides ETFs, let us know. Somebody might be doing it and they're just not, they're not in the mainstream. Yeah. But at the end of the day, our choices are mutual funds, which are very equivalent to, the TSP funds I set up, which Jerry's going to show you. But that's wise because by and large, if you know anybody with a 401k and if they've made more than one move in a year or two moves in a year, I would be amazed.
Yeah,
and that's not what you should be doing. You should be actively managing it, just like we're teaching you guys how to do the TSP. What Jerry's getting ready to share with you is you can share with your friends. They can manage their 401k and their IRA the same way. The performance is the same because the options are there.
So the other thing on a 401k, obviously this is outside of government employees and military service members. But if you work for,
GM.
ExxonMobil, GM, whatever, they incentivize you. One of the options in their 401ks is company stock, right? And your employer may also match a higher percentage of your contributions if it goes into their company stock. So in addition to the mutual fund offerings, you can put, they incentivize you to buy company stock.
I hope
right?
their stock is performing.
It's good for them. It's good for you. Right. Well, that goes to this one, right? But if you have the bulk of your 401k money in company stock, your long-term financial security is at greater risk than if you had built a diversified portfolio using the...
Ding, ding, ding.
Yeah. So in that case, I mean, if you work for a company, you should absolutely be following the chart of the ticker symbol of the company that you work for.
If you work in a tech company or an energy company, there might be some good options for you.
Yeah.
If you work for a company that is not high performing in the stock market, it's probably not the best option.
Right. I mean, there's a lot of things to think about there. If you have it, we haven't given that a whole lot of thought because, fortunately or unfortunately, we haven't worked for a company like
not going to happen
like that. Some 401k plans allow you to buy a wide assortment of securities through a brokerage account, sometimes called a brokerage window. That's what we were kind of talking about. So you can buy individual stocks, bonds, other securities. The big thing is that
if they allow it.
If your 401k plan has a brokerage window, it expands everything beyond mutual funds, which is what we try to do with Ubiquity. But it creates other fees and other challenges.
Much like the mutual fund
Fractionals
window.
being a big one.
Yeah. I mean, the mutual fund window sounds great until you try to actively manage it and realize the fees are going to outweigh the performance. And at the end of the day, we perform better just by doing the index funds.
Yeah. Ironically, our, quote unquote brokerage window only gave us access to mutual funds, which just that I can't even talk about. It just drives me nuts. But again, we're in a 401k plan, so there's no capital gains tax on gains that you make within the 401k, which is awesome, right? Regardless of whether it's Roth or traditional. 401k brokerage account generally has an annual fee, which, as we know in TSP, is in addition to the regular fees you're already paying. There may also be transaction costs, commissions on each trade, which for us is $28.50 each time you buy or sell in the mutual fund window. So corporate has the same kinds of fees, is what I'm saying. And like we said before, you could pay higher fees for mutual funds you buy through the account than on funds that are part of the plan menu. So if you want to buy an S&P 500 fund in the mutual fund window or the brokerage window, it's probably going to cost you more to buy it in the brokerage window than if you did it in the regular plan, right? So you don't want to buy things that are available cheaper in the same plan.
Right. Like our version of the C fund, right?
Yeah.
So I know you're going to get to this in a second. There's an equivalent Vanguard fund that there's like almost no fees, and it's easy. You can do percentages, right? So quote unquote, you're doing fractionals, right? So you don't have to pay for a share of the Vanguard mutual fund. And so it's more efficient and more performance oriented because if we went in the brokerage window and bought the S&P 500 ETF, there's all these fees associated with it. Plus I have to buy a full share. It gets crazy. So why would you do that? That's just kind of reinforcing what you're saying.
Right. There's a lot of obviously we've done a lot of work and research to put the show together. This one, and so
personally done these things too, not just like reading it. Like we've gone through all this and started to kind of realize these things. It's nice to be able to see all the sides, right? Yep. So obviously we've been in the military, the government, and in corporate entities, and now being in our own private entity.
Yep.
Like that's all the entities. Well, nonprofit, I guess, if we worked for a nonprofit.
Yeah.
But yeah, and so the options, at the end of the day, what I've kind of come across is that the TSP isn't all bad.
No, it's not.
Like you kind of you'd love to have more options, but at the end of the day, if you'd have to buy into our methodology.
Yep.
But if you do buy into our thesis and our methodology, you don't really need much more.
No.
You're only the performance, the delta in performance isn't going to be high enough to warrant all the extra effort.
Yeah. At the end of the day, whether it's the government, for TSP and military, or companies, they're outsourcing. They're buying a product, which the product is the ability to give their employees a 401k. And so obviously the provider has to make money. And the financial services industry has put together packages that enable them to make money and provide it to their customers, the government, or other companies. And so we're getting, we don't make this stuff up. Like the government doesn't make up the CS&I funds. It's a product that we bought from BlackRock.
Right.
So that's all. But in terms of the 401k, you're limited to what your company has to offer it and buy it for you, because there's a fee to the company every month for every employee, as we found out. So your company has to buy the 401k product for you. Then the company gets to put its restrictions on what you can do within that product.
Yeah, and the amount restrictions are, and you're going to talk about IRAs next, right?
Yes.
So you'll see, just so you guys can kind of see why can I put, $20,000 in my 401k? Why can't I put that in my IRA? Well, you're going to see after Jerry explains an IRA is much more flexible.
Yep.
You can do a lot more things. So all of a sudden, it's more dangerous.
Yeah.
Right. So we're not going to let you put $20,000 a year in your IRA because you don't know what you're doing. Right. I hate to beat that up, but people need to understand that is the underlying, principle of all of this, is that you're not an educated investor.
Yeah, they're protecting you from yourself.
Exactly. And I'm not saying that's a bad thing. And I know when I'm saying all this, I sound sarcastic. It's mostly because I'm just fed up with it, because we are educated investors, right? I mean, Jerry and I, because of our licenses or whatever, right? There's a certain thing you can either test out and be a qualified, the word just went out of my head.
I'm trying to think of it too.
Yeah.
It's a qualified investor.
Investor. Or you can have enough money, thinking that if you have enough money, you know what you're doing.
Right.
Or you can go get, a Series 65 or a Series 7. You take these tests and kind of test out. Yep. And what's funny is magically now you can do all these things that you couldn't used to do. Right. And it just doesn't make much sense. But then again, I guess it does, right? Because all these rules were written back at a time when you really could get taken advantage of.
Sure. And you still can.
And you still can, but you can self-educate a lot better now.
Yeah.
Hence what we do. Like, this kind of thing wouldn't have been possible in 1956 or whatever, 1970s. So, but it's all about education. That's really why I'm kind of coming full circle, is all of these things these rules and things that we see that we kind of don't understand. Most of it is driven by the fact that we haven't had educated investors. It's not something we teach in high school. Yep. It's not even something we teach in college.
Right.
I'm going to let you go.
Okay. I was just going to get off on a tangent, and I think I just barely want to do it. So one of my friends texted an article about Susie Orman the other day. I'm not a big Susie Orman fan. I haven't watched her show in probably years. And who's the other guy?
Yeah.
I can't remember his name. I can't stand
I can
that
see
guy
him.
either.
I can see him. But there's other people that make fun of them both constantly.
Yeah. So, I mean, they're basically in the camp of always be fully diversified and all that, right?
Regardless of performance.
Right. And so the interesting thing in this article was that, Susie Orman's talking about how people lost a bunch of money in 2022. They're going to lose a bunch of money in 2023 because of all these reasons that, you can hear about every day on the news. But at the end of the day, right now, she is 80% cash and 20% short-term securities, which is essentially the same as cash. So she's basically 100% G fund right now.
Yeah, why do you think that?
Why do you think that is? Right?
Well, that's a class. Dave Ramsey.
Yeah.
Dave Ramsey, Susie Orman. What's the other guy? Robert Kiyosaki.
Well, Kiyosaki's different, but yeah.
Kiyosaki loves to make fun of those two because he says what he says, and I don't know whether it's all true because we don't follow them enough to know. But what he says is that they don't do anything that they espouse. So like they don't follow their own rules. Right. They think that you're dumb, so you should do this.
Right.
And so if you're not, and it comes back to education, right? And I shouldn't say dumb, but if you don't know what you're doing, so we're going to make these, they've made their living off telling people what to do with money.
Right.
And if you listen to them for 30 seconds and you do know what to do with money, you're like, I don't know if I'd do that.
Right.
Like, and then you come to find out you're not doing that,
doing it,
right? You're all cash right now. Why is that?
Yeah.
Yeah. Well, I mean,
It pays to be educated.
It does.
And
that's what
don't
we're here
believe
for.
What everybody tells you. It's
take what we say with a grain of salt. But I tell you what we represent more than anything is not that our methodology is better than any other one. It's that you have to have one. Yeah. You have to have a plan. You have to have a methodology. If you don't, then just don't do any of this.
Don't be in the game.
Don't be in the game because
they'll take your money.
You will not win over time. Just educate yourself and make a plan. If your plan doesn't align with ours, we're going to be happy that you have a plan. Period. Right?
Yeah. And you keep tweaking the plan, and
that's it.
Okay. So that was a 401k. IRA. It's an individual tax-deferred retirement savings vehicle. Max contribution, much less, $6,500 a year in 2023, plus an extra $1,000 if you're over 50 years old. I'm not going to get into it here, but just the Roth, if you have a Roth IRA, you are investing after-tax dollars. Okay, if you have a traditional, you're putting pre-tax dollars in, which means you're contributing more, and those contributions are growing over time, but then you pay the taxes at your income rate when you withdraw the money. So there's a lot of controversy.
The simple version is what do you think your tax rate is going to be when you're going to use the money? That's it.
Yeah,
which
is about impossible to know.
I know that. I was going to say simple, but that is the simple answer. Anytime anybody asks me that, I'm like, I don't know. Do you know what your tax rate's going to be when you're 65, 75? Right. If you do, if you have a plan and you think this is where you're going to be, I mean, I hope my tax rate's smaller. Right. So one might not be better than the other. Right. Some people think it's going to be higher. Ours could be higher. If it's higher, then there's a different choice. It's really based on when are you going to use the money.
Yep.
When you withdraw that money, what's your tax rate going to be? Yep. And you might not even know because you don't know what the tax rates are going to be then.
That's true too. Yeah, 100%.
That's a lot of assumptions going on there.
So you go out yourself, right? We're not talking about you being an employee. We're talking about you as an individual.
Yeah, you don't need an employer to do this. There's no sponsor. There's no...
Right. You go out. It is designed. We're going to talk about it on the next thing. It's designed primarily for self-employed people, but you don't have to be. So you can go out to Fidelity or Schwab or wherever. Betterment and SoFi are kind of two of the new, what's it called?
Providers?
Online.
Oh,
there's a term for it that's...
Don't know.
I can't think of it. It's all online as opposed to sitting down with a guy at Fidelity or Schwab. And it's not just limited to mutual funds, right? That's the biggest one we've been talking about.
I mean, none of these you really have to sit down with anybody anymore. I mean, we've opened up IRA accounts as test accounts for various reasons at just about every provider there is.
Right.
And so the only caveat to that is you can only put the maximum in all of them, right? So 6,500 spread across 3 or 4 of them. We're doing it for different reasons, right? We're testing things, but the point is you can open up an IRA account in like 45 seconds, I think. Yeah, like if you have all your information in front of you, you can go to Fidelity, you can go to Schwab, you can go to wherever, and you can open an IRA in like no time. And soon you'll be able to do it with us.
Yeah, absolutely. Okay. So this one we took from Investopedia. What is an IRA? It's designed primarily for self-employed people who do not have access to workplace 401ks. Okay. So the big takeaways, IRA are a retirement savings account that have the tax advantages that we talked about. There's a whole bunch of different IRAs depending on what your self-employed situation is. And so we're not going to get into all those, but just know that if you go looking for it, there's a bunch of different options.
Different options, and at the end of the day, you can only put the max amount in.
Right, regardless.
So it doesn't, you know.
Yeah.
It doesn't
There are
really
tax
matter.
advantages and some things in
A financial planner can help you figure it out.
Yeah, for sure. And we still have the same kinds of rules that we have in TSP. And they're IRS rules, right? You can't withdraw before you're 59 and a half. If you do, you lose all those tax advantages, and you pay the 10% withdrawal penalty. In TSP, obviously there are different rules. If you're a 6C law enforcement, firefighter, air traffic controller, your retirement age is earlier than it's 57, so therefore they can't have the 59 and a half rule. But in general, it's 59 and a half for IRAs and for TSP. And there are annual income limitations to how much you can contribute. Okay. The other interesting one about an IRA is this thing called the self-directed IRA. So it's more expensive to buy into it. It takes a lot of looking around to find it. But if you do find them, you can invest in things like real estate in your IRA, commodities. You can do options. There are some things that are still off limits, the riskiest things. But
like IPOs and
yeah, but those are for qualified investors. That's
right.
the thing. There are things that you can't get into in an IRA at all.
That's pretty wild to be able to invest in real estate and commodities and things like that in your IRA. Yeah, I mean, if you're highly educated, that's a great thing for you.
Yeah. So one of my friends is a realtor, and he has a self-directed IRA, and he buys rental properties in his IRA. So now, as the value of the home appreciates, he keeps it. You have to keep it all in the IRA, right? But as the value of the home goes up, he's not paying taxes because it's in an IRA.
Right.
I mean, it's a really, really good way to do it.
Again, if you're educated,
you got to be educated.
Awesome option.
Okay. Because IRAs are meant for retirement savings, there is that early withdrawal penalty, 10%, if you take it up before 59 and a half. However, because we always have to have howevers, there are some notable exceptions. If you withdraw for educational expenses, so if you're paying for you or I think your kids to go to school, so this might be an option outside of a 529 plan, you don't pay the penalties for early withdrawal or for first-time home buyers. Okay, so lots of rules, lots of things to think about, and you may or may not fit into one of those categories. Okay. So like we said, Vanguard is one of the more common ones, and we're gonna just relate the TSP funds to the Vanguard mutual funds to the Vanguard ETFs. So if you're in TSP, obviously you know the CSI F and G funds. If you're in a 401k, most of them are Vanguard mutual funds, and if you're in an IRA or a brokerage window in a 401k, you can do Vanguard ETFs. Okay. So this is the chart you want to kind of copy paste and put it on your refrigerator or whatever.
Yeah, Jerry, if you can remember to take that one picture out, I mean, save that as a picture.
Yep.
And I'll try to blast that out to all of our. If you're on our email list, I'll try to blast it out.
Yeah,
if
for
you
sure.
can remember to do that.
I can do that, and I think we're gonna put this on the tab in the site. There's going to be a post, and we'll put this chart up there, and so you guys can refer back to it.
Yeah, the idea is this. I think you're talking about. We were talking about, hey, let's put this up there for our members. You can go up and we'll find a way to put this on the tab somewhere, so you won't have to go back and look at the show.
Right.
You can kind of have here's a simple little cheat sheet.
Yep.
That says, hey, if your spouse has a 401k or your buddy, you can follow the same allocation model that we do.
Yep.
Using this little cheat sheet.
Yep.
And make your changes just same as we do with the model.
Yep.
And you're going to get the same generally the same performance. Now, some of them are a little wiggly. They're a little different, but not much.
Yeah.
Not enough that
that
would
too.
make any difference.
Right.
Yeah, and if any of your friends want to just join and follow along, they would be happy to have that too.
No, I mean, we have plenty of people that follow.
The funny thing is you don't have to have a TSP to follow this methodology.
Right.
It's just that we started this because we wanted to help those people first, right? We wanted to help our people,
our group,
our folks. We want to help military and government folks, but it isn't any different in your 401k or IRA.
I mean, it's different in terms of the 2 move a month rule, and the noon rule is drastically different in some 401ks and definitely in IRAs.
But you know, I mean, what we've learned over the last few years is it's not as detrimental as you kind of think. Now, can you squeeze a little more performance out? Yes.
You get a lot more work too.
Yeah, I was going to say, but you have to be way more. There's a lot more resources you have to dedicate to make that happen. If you look at these 5 funds, and whether they're in the TSP, so the middle one would be 401k, and the one on the right would be IRA.
Yep.
If those are your only choices, if you make those your only choices, right? You say, hey, this is what I'm going to limit myself to. You don't really need to move more than twice a month.
No.
You could. Like in our 401k, we could move more. The amount of work that we would have to do to get just a little bit more performance, it's not worth it in the big picture. And again, these are retirement accounts.
Right.
If you're trying to make $3,000 a month off your retirement account, you're in the wrong business. It doesn't work like that.
No.
You can do that in a brokerage account if you're good and you know what you're doing. Yes, you can, and you have some money, you can do that. We're not talking about that. What we're talking about is spending 20 years dedicated to actively managing your retirement account so that when you're done, you can be done. Yeah. Right? That's what we're talking about. A lot of people, most of these people are just on Facebook, I've noticed, that just want to try to make what we talk about
day trading.
We're like, no, bro, that's not it. Yeah. It's not it. Right. This is not it. What we're trying to do is so that when you retire, you could just go buy your Harley, your boat, go live in your house, go in whatever your version of retirement is, and you have the money to do it.
And at the end of the day, it's all dependent on what the market does. I mean, the best you can do if the market is going down is to not go down with it.
Just be out of it, right?
Right. All right. So if you go back to that sheet, here we are with the TSP funds, right? We all know what those are. If you're in a 401k, the VFIAX.
We might want to redo that thing to put 401k on top too, so they can be more.
Yeah, I can do that. TSP, 401k, and IRA. So if you're in a 401k, which we are, these are the ticker symbols that we have available to us in Ubiquity in our 401k. So the C fund is, I'm going to say equivalent. I'm going to show this on a chart in a second, but generally speaking, the performance that you get in the S&P 500, which is what our C fund tracks, you're going to get with this mutual fund. Not counting fees, right? But that's what you're getting with that mutual fund. It's the same as the VOO, which is Vanguard's version of an ETF, of S&P 500 ETF. Okay? So it's the same thing with the other funds. S fund for TSP, VSGAX for the mutual fund version, right, for 401k, and VXF is the ETF. Same thing for I fund, F fund, and G fund. I kind of had to do a couple. I had to make sure that this was actually correct, but yeah, BND is the aggregate bond fund.
VND was probably already taken by somebody else.
Probably, yeah. I mean, BND makes sense because it's bond. Yeah. But not having the V in front of it kind of threw me for a minute. But that is the Vanguard equivalent to the AGG or our F fund.
And another thing to kind of point out, because I think this will happen. Let's say somebody's listening and their spouse has a 401k, and they after they watch the show, they go, "Hey, honey, did you know you could follow the same things I've been doing here with my TSP?" And they pull up their 401k account. You're going to see a laundry list of things. Yep. And so you're not going to just see these. Right. And so what those other things are variations of these that can be very confusing. And you're going to see a lot of life cycle. Which are like L funds. They're going to have those target date funds. So there's going to be a list of probably 15,
at least
20, maybe more. But what we're showing you here is the ones that we went and showed that, these line up the best with those 5. So that if you're following our methodology, it's easy peasy. Right. I go put 50% this, 50% that. It's
and that following along.
Right. And the other thing you'll say, and you may get into this in a little bit later, I can hear people, if I was watching this, I'm one of those folks that don't have Vanguard. Mm-hmm. Whatever you have in that list, you can find the equivalents. Mm-hmm. And the way you do that is what Jerry's going to show these charts. You go out and look at your list and you go, okay, let me see this. Let me look at the C fund or the S&P 500. And I go, well, those track exactly the same. Right. That's what that is. A lot of times it'll even have it in the description. Like international, emerging markets. Yep. That's going to be something close to the iFund, right? Small cap, Ding, ding, ding. Look for those things to get you closer. Whatever 401k options you have, they're in there somewhere.
Yep, they're in there.
And so if they don't match up with these, don't lose hope. As a matter of fact, I mean, if you send us a list of what your 401k has, at some point we'll take the time and we'll try to decipher them for you. You can probably do it, but let's just say you're just like completely lost. We'll try to do it. If you just send it over to support@growmytsp.com, we'll try to give it a shot.
All right, so here's what we're kind of talking about.
Hopefully we don't get 50,000 emails for that.
Here's what we're kind of talking about, right? So SPX is the S&P 500 index, all right? And that's in black. The VOO is Vanguard's ETF of the S&P 500. The VFIAX in red is the mutual fund for the S&P 500. And this is what you want to see. There's very, very little deviations. It's, you can't even see the red. Like, I think there was a couple of places here.
Yeah, it's
Believe
like,
me,
is
I can't even see it. The red is behind there. So there are three charts
really
superimposed on top of each other, but they track almost exactly. So every once in a while I get things on Facebook that say, "Hey, how come the iFund's up 3%, but the EFA is up 1.5% or whatever?" There are variations. The funds are designed to track the indexes. Mm-hmm. But they're not exactly the same. Yeah. There are going to be little variations, but as you can see from the chart, the variations are very small, and it's the best we can do.
Yeah, and it's long game, so it doesn't matter.
Yeah, no, it's not going to matter that much. Okay, so hopefully that gives you guys an idea and/or generates questions. If you have questions about this specific stuff, definitely hit us up in the comments, and we will point you guys in the right direction. All right, TSP fund charts. We've been talking about here for quite a while. We got the 20-week moving average line in blue. This is basically a 3-year chart. We're going back to the bottom from COVID. It's a chart of the S&P 500, which is our C fund, and we have the 20-week moving average line in blue. Each price tick is 1 week of price movement, and we have the relative strength indicator down here. So ever since we got back above the 20-week moving average line after COVID, we stayed above it. Every time we came down, we got support at that 20-week moving average line until the first week of January, where we crashed through it, and it began the bear market of 2022. Ever since then, so obviously the 20-week moving average line is a great support for us in 2020 and through 2021. And then it became resistance, right? We have a couple of overshoots, right? We can argue where we are right now, but for the most part, when price comes up to that 20-week moving average line, it rolled over and went to make new lows, okay?
Yeah, and you'll see if you go in the newsletter this week, right? If you're a member, you're going to see way more detail there, right? Yep. We dive down because there's a lot of things that are in there that are kind of we're not hitting on because we don't talk about that in the show. Right. But just like if you're not a member, that's what we give our members. We dive in there more to see like what else is going on. There's a little bit more to the story, right?
There's a lot more to the story. Yeah. So where are we right now? We've broken a couple of different trends here, right? We got lower lows all the way from January to October last year. Now we have this December, we have a higher low, okay? We have a higher low, which is positive. On a weekly basis, we're above that 20-week moving average line, and we are above 50 in relative strength and increasing. So the idea from our methodology is to be in the stock funds when the trend is going up. Now, we were in a downtrend to this point. Could the longer downtrend continue like this? Yes, it could. But could this uptrend be happening? Right? Yeah, because if we connect to these bottoms, we can connect a trend line that starts moving higher. The trend cannot move higher until price is above that 20-week moving average line, which it is right now. So I'm not saying you should buy here. It's absolutely possible the price could roll over, get back below that line, and keep moving down. But the way to get into the stock funds as the earliest reasonable time is to get in when it's above that 20-week moving average line and the technical indicators are moving higher. Okay. S fund, same kind of thing. The 20-week moving average line provided really good support all the way along until the S fund was back in November 2021 when it rolled over. And ever since then, that moving average line provided a significant amount of resistance. And right now we're back above it again. So on the S fund, we have what you could probably argue is an inverse head and shoulders pattern. And we talked about that actually yesterday in that document we put out yesterday. So left shoulder, head, right shoulder, a neckline here at about 1715 that we broke above this week. So if this pattern continues, S fund should move higher. And we got RSI above 50, which is kind of supporting that. Doesn't mean it's going to happen, but it's a really, really strong setup. We definitely want to see price take out that August high before we get too excited that we're going to keep moving significantly higher. I fund has been on a tear since it broke through that 20-week moving average line back here. Came back, corrected a little bit in November, December, but didn't even get back to the 20-week moving average line. So I fund is super strong. It's a little bit overextended at this point, I would say. You know, we're approaching that 70 level on the RSI. You can stay there at 70 for a long time, right? We can stay at that 70 line and price can continue to move higher. So just because we get up to 70 here doesn't mean that, you know, the I fund's going to roll back over. But in the short term, it's pretty overextended. F fund has had a really strong rally since the low there in October. Had a pullback 1 week below that 20-week moving average line, but if we discount that, we got some pretty good support there, and it rallied off it. So, and we've been above for a few weeks, 50 on the RSI. So F fund is looking pretty strong as we're looking at the chart right there, at least on a weekly basis. All right. Questions? A lot of stuff there on that show.
A lot of good stuff. I hope people like that. If you have more questions about 401ks and IRAs and how you can line that up to use our methodology, please just put them in the comment section wherever you find this video. If you have any other questions related to this or anything else, you can put them in the comment section of wherever you found this video. You can always hit us up at support@growmytsp.com. The customer support folks will forward to us if they need to, or they'll answer your question.
Awesome.
I feel like I just got to put that on repeat. Can I put that in words up there?
Right.
All right,
to
guys.
the bowl.
Hope you had a great week and have a great week coming up.
All right.
Take care, guys. We'll see ya.